Hey guys, it's Saturday, and if it's Saturday, you know what that means. It's time for the top 20 high yield stocks of the week, according to the MaxFactor. MaxFactor is my own proprietary metric that I made to measure the risk and reward of high yield ETFs, specifically covered call ETFs, but I'll look at any ETF that pays a dividend of more than 6%. The whole idea of the MaxFactor is I try to find ETFs that pay a high yield, but that don't have to sacrifice too much return, that have a good mix of risk and reward, where you can get a decent NAV return and at the same time a fairly high yield. The thing that's tough about that is the yield and the NAV return work opposite of each other in these high yield ETFs. A big yield subtracts from the NAV return generally, and the other way around. And lots of times ones with a good NAV return will have a smaller yield. That doesn't mean, though, there's not ETFs out there that have a pretty nice blend, and that's what we try to look at here on the MaxFactor. Stick around and we'll get right into the middle of it. All right, here we go. We're going to start with the first five, or I guess they'd be the last five, 20 through 16. So we have QDTY, QDTE, FEPI, Triple QI, and KQQQ. Well, I'll be darned. This is the battle of the Qs, isn't it? We have four funds in here that are NASDAQ based, and FEPI, I would imagine FEPI has 15 to, I think they have 15 stocks last time I checked. Every stock FEPI has is on the NASDAQ. I guarantee you. I'm not going to check, but I guarantee you that they have, it's basically a NASDAQ portfolio as well. I may be wrong. They may have some others on they may have something on the Russell, but I really don't think so. This is the battle of the NASDAQ. Well, this makes a really interesting point here. Let's do our first battle royale. We're going to do a final four. We'll exclude FEPI because it's more concentrated, but let's just compare the other ones. Why don't we? We'll start with QDTE versus QDTY, and we're going to go back. We're trying to pick up short-term momentum. So we're going to go back. We're trying to evaluate the recent prospects of these companies. So let's just go back to quarter. Let's see how QDT and QDTY did. Now, QDTE is from Round Hill, and QDTY is from YieldMax. Now, let's see what we have. All right, so just the quarter. Well, would you take a look at that? QDTY is actually ahead for this quarter, 11.89% total return to 11.09% total return. Wow, both doing well. Let's look at our second matchup. Our second matchup is going to be KQQQ against QQQY. That's a blast from the past. That one is a real innovative fund. All right, so what do we have here? KQQQ is our winner here. KQQQ really putting it on the other funds. All right, so you know what that means. It's KQQQ from Curve against QDTY from YieldMax. KQQQ is our winner in our first battle royale. Very good. All right, let's see what we have next. Let's see let's just run FEPI against KQQQ to make it fair, just to finish out the process. FEPI will be our wild card. We'll put it in here and see how it compares against the winner. All right, well, KQQQ out of the top five is definitely the winner. Okay, let's do this now. Let's go the next five. Number 15 is Soxy. Number 14 is Biddy. Number 13 is Baggy. Number 12 is Biggie, and number 11 is CLM. Wow. All right. So out of these, it just looks like we have to compare Biddy and Baggy because they have similar names. It's just a natural comparison. We can look here on our rundown. Column C is the yield for the quarter. Baggy has more yield than Biddy, 25 to 19. Biddy actually has more return, but a little bit less yield. So that would make total sense. Let's just compare Biddy and Baggy on a total return basis and see what's up. Biddy versus Baggy. It doesn't get much closer than that, does it? Well, I'm just going to declare that one a tie, right? CLM is another interesting one. I always talk about balanced funds. And so by balanced, I would say the yield and the NAV return's the same. I think the ultimate fund would have 100% NAV return and 100% yield, right? I mean, and you're getting a lot of your return in the form of yield. You're getting a lot of your return in the form of NAV return. Well, CLM is pretty balanced. Let's run CLM against Biddy. Let's run CLM against Biddy. See what we have here, because Biddy and Baggy are the same, so I'm just going to use Biddy. Well, this is pretty darn close also. You can see that CLM was steadier, led the whole way, but then it got passed lately by Biddy, but then it overtook, then Biddy overtook it again. And Biddy, or actually CLM closed a little bit ahead. All right, so let's go here. Number 10 is MSFY. This is from Curve. It's a good one, 12% yield and 14% NAV return. That's pretty balanced. MSFY has been around for a year. If the fund has been around for a year, I put the total return in column E. All right, so, I mean, MSFY is a balanced champion also. 13% yield, 14% NAV return, same thing as CLM. I think CLM plus MSFY might be a good, interesting battle here. Here we go. Which one do you think is going to win? Wow, look at that. CLM is really doing well. CLM is beating MSFY, although it's close, 15% to 13% as far as total return goes for the quarter. And next, we have number 9, GPTY. I like this one. This one pays a lot more yield than MSFY. But it has a little bit less NAV return than MSFY. Number 8 is Goop. Goop is from our friends at Curve. 15.9% yield and a 22% NAV return plus a 22% yearly return for the year. That's really good. Good job, Goop. COIW. Okay. Well, this one's interesting. Look at this one compared to Goop. This one yields about 4 times as much, not quite 3.5 times as much, and it also out returns on NAV. Now, COIW is a beast. Now, the downside of COIW is it doesn't have as much history. We don't know how it's done over the past year because it hasn't been around for the past year, but this is the story of 2 different styles. Goop may work for you, but COIW has it beat by both accounts. And that's just as of the past quarter. Remember, the past quarter's a short look back period. I did a show this morning with Ambassador Kwan and ETF Inspector and Rod, and I was talking about the concept of variance in these funds. And a good way to think about variance is luck. When you sell options, you win 6 times out of 10, but it doesn't mean it happens exactly like that. You don't win 6 and then lose 4. You don't. I mean, they don't have to be evenly distributed. You may win 10 in a row. You may lose 10 in a row. The idea is after 100 or after 1,000, you should be about 60-40. In the short term, luck and just luck, the way the ball bounces, can make a fund look like it's doing way better or way worse. So showing these quarterly charts is basically could kind of be looking at the variance also. So just keep that in mind. I mean, some of these have just had a heck of a run. COIW being one that's had a heck of a run on the way up, but its parent company, Coinbase, Coney's not the parent company. Coinbase is the parent company. Well, they had an earnings miss, what is it, a week ago now, or is that a week and a half? Anyway, they had a week and a half now. So, and that earnings miss, it hit the parent stock. And so, of course, it's also going to hit the derivative stocks. In any event, you could see right here, these are pretty As far as the total return goes, they're pretty close. It just depends what you're into. Do you want a high beta stock, meaning a stock that is super volatile and goes up more than the SPY and down more than the SPY? So it overcorrects on both sides. And if you're fine with that, that's fine. But if you want maybe a slow and steadier stock, at least over this quarter, Goop might work for you. But you can see as far as getting to the final destination or getting to the wherever they ended up at about the same spot. They just took different paths getting there. All right, let's see. Now, number 6 is Palti, Platy, whatever you want to call it. Now, this one's incredible. Now, Palti has even more yield than COIW, about 10% more. However, it has less NAV return. COIW is a NAV return beast, a 38% NAV return. Right now, COIW is our NAV return champion. I mean, that's 38%. The next closest one on NAV return, and this is just for the quarter, would be Goop at 22. They're both doing well. Let's line up Palti and COIW and see what we think. Here we go. Well, you can see, look at this bottom chart, which is the one I use because it's not dividends reinvested. If you reinvest dividends, God bless you. That's a great thing to do. But I just want an apples to apples comparison. A lot of people take the dividends and live off them, pay margin with them, do whatever. And so I don't think it's a fair comparison to assume that you're reinvesting the dividends. So looking at this, just taking the dividends in cash and just whatever, just put it in a bank account, living off it, whatever you want to do. I can't even tell which one's ahead. It looks like we have to look here, but Palti got it just a little bit. Palti got it by just a little bit, but you can see Palti hasn't been doing near as well. COIW had a heck of a run. All right. We ready for number 5? Number 5 is YETH. Wow. We have a new yielding champion out on the whole chart. This is the highest. I'm sorry about that. This is the highest yield yet. 84%. That's incredible. 14% NAV return, hasn't been around a year yet. Maybe if we get another crypto-based one, we'll have something to compare it with. There we have AMD from YieldMax, paying about a 70% yield with 20% NAV return, and they have a record. They have a 13% total return for last year. AMD's a good one. Who do you think's number 3? Let's check it out together. PLTW. Wow. Okay, so PLTW is from Roundhill. This is a good one, paying a lot of yield, 47%, and offering a lot of NAV return. In fact, it's our NAV return champion so far. The next highest NAV return was COIW at 38%. So what I was thinking here on PLTW, let's compare it with PLTY. Let's have a Roundhill against YieldMax comparison. But first, let's just compare it with our eyes. Let's give it the old eye test. Well, the YieldMax one has about 50%, 40% more. What am I talking? Like a third more, like 33, 35% more yield. And that's YieldMax. You would, true to their name, that's what they're going. That's kind of their deal. And they go for yield. But like I always say, these two things are at opposite extremes of each other. They affect each other. A high yield takes away from your NAV return. And a high NAV return is generally found in stocks that have a lower yield. Not always, but generally. So we would expect that. I would expect it. I would expect the NAV return to be less on the YieldMax one. But let's just look over here and see how we look on total return. So let's run Palti against PLTW. Great job, PLTW. The Roundhill one is really pointed on. Now, remember, Roundhill uses a little bit of leverage, but if that's what you want, that's a good thing. They both offer a really generous yield, and they're both doing well as far as NAV return goes. But we would definitely call Pulte the champion here. And the reason I built the MaxFactor is so I don't always have to be looking at this right here. I would expect Pulte to have done better, even if we hadn't lined him up, or a PLTW to have done better, because it's ranked 3 and Pulte's ranked 6. The PLTW has a MaxFactor of 4.8. PLTY has a MaxFactor of 3.3. The MaxFactor is just derived from the yield and the NAV return and the volatility. So, number 2, NVDY. Wow, this is a good one, and I see a natural comparison coming here. What about NVDY against AMDY? They're both in the same business. They both make graphic processing units, chips. All right, well, let's just give it the eye test first. On yield, I'm going to call that as the same. 69 and 71, that's the same, basically, right? Let's look at NAV return. AMD has them on NAV return a little bit. But if we go back a year and look at total return, and total return for the year is not a factor on the short-term MaxFactor. Because also, if it was, I couldn't rank all these ones that haven't been out a year yet. To be in the MaxFactor, you have to have 3 months worth of data. You have to be around for a quarter. But in any event, boy, NVDY has, had great NAV return last year. But this year, AMDY, or this quarter, AMDY is beating it. So let's just line up AMDY against NVDY. Good job, AMDY. AMDY is absolutely killing it. And you might say, so how come NVDY is ahead in the MaxFactor? Well, the MaxFactor also looks at something that you can't see here, but it looks at volatility. And it uses volatility as kind of a tiebreaker. And what the MaxFactor is saying, at least this quarter, AMD has been, NVDY has been a lot less volatile. And we can see that with our own eyes. Look at how the NVDY line has just gone straight up and to the right, and the AMD line has been underneath, on top. That's more, you could call that more, well, it's just more volatility. Doesn't mean anything bad or necessarily good. It just is what it is. So when you factor all 3 factors in together, the return for the quarter, well, the yield for the quarter, or the yield for the year, the NAV return for the quarter, and then you factor in the volatility element, NVDY came out on top. But that's why I like the MaxFactor though. If you were just looking at total return, you would probably choose AMDY. And these are both good. Once you get into the top 10, I mean, any of these stocks are just killing it. They all have a lot of NAV return and a lot of yield. I mean, so anyway, let's go to number 1 and see what we have. NVDW. Wow. Okay. Well, now we're going to have another Roundhill versus YieldMax matchup. So let's just give it the eye test. On the eye test, the YieldMax one has more yield. Okay. Well, of course. So what else do we know? We know that we almost necessarily know that the one with less yield is going to have better NAV return. It's just the way it works. All right, so let's line it up together and see who has better, and see who did better in a head-to-head matchup. NVDW from Roundhill against NVDY. Head-to-head matchup, and NVDW is doing great. These W series single stock funds have been very successful and very well received, although there is some drama going on Twitter. There's kind of shots being fired back and forth from Roundhill and YieldMax. YieldMax is alleging that Roundhill is just selling stock. They're just using leverage and they're selling stock. They aren't really generating option premium. And when you look at the prospectus, that does look like that's what's happening. So, just be aware of that, but just be aware of that. I mean, there's no rule in life that says you have to sell stock. I mean, you have to sell options. You don't have to. You can. Some people manage in retirement by selling a little bit of stock to meet their needs. And depending on the way the market goes, I always talk about path dependency. Depending on the path dependency, the sequencing of returns, risk, and all that kind of stuff, one strategy might work out better or not. With me, the reason I kind of cover yield max funds a lot is I prefer the ones that sell options. I think that is more repeatable than selling stock. But if we just want to look at returns for this quarter, boy, Round Hill is doing well. So now let's look at NVDW against NVIDIA against the parent asset. Well, that's impressive. NVDW is beating the parent asset. Now, covered call funds don't usually beat the parent asset. Sometimes they will over a short time frame, but over a long enough period of time, they just won't be able to beat the parent because of the capped upside and everything. And even if it's a covered call spread fund where they have some of the upside uncapped, or even if it's a fund that just sells calls on half the portfolio, they generally don't beat the parent asset over a long enough period of time. However, like I just said, NVDW is not really a covered call fund. They have leverage exposure to the stock, and then they have a swap. So, maybe the fact that it's not really a covered call fund and the fact that it has leverage on it means it can beat the parent sometime. That's what you're interested in. That's awesome. But I would caution you, I don't think that's the same conditions going to exist in an extended pullback. These funds that just sell stock in an extended pullback, they're going to be selling stock at a lower price. And then if the next month at an even lower price, and then when the market does bounce back up, they're going to have less shares of stock, where yield max in theory can keep rinsing and repeating and should have the same amount of stock. So I'll expect yield max to do better in a pullback and even in the first stages of a bounce back. But NVDW, Round Hill, should do better in a runaway bull market, which is what we've had lately, a face-ripping bull market. Well, it's a fun time to be an investor, isn't it? I have some fun things coming up on the channel today or this week. I have Mike Coe from YieldMax. He's YieldMax's new analyst. He's going to be on my show Thursday, and I'm really excited about that. All right, so I built, I get some criticism from time to time, and some constructive criticism for being too conservative. So I built a list that's a little less conservative. And what I do is I go back and look at a year's worth of performance. And I took the element of safety out of this one. I did not factor the volatility. We just go back a year. We look at the quarterly performance and we look at the yearly performance. And this would be a longer term version of the MaxFactor. Now, the disadvantage is I can't compare that many funds because a lot of them haven't been around for a year. But just for fun, let's take a look at the long-term MaxFactor. But like I say, this is the MaxFactor. The short-term one is the true MaxFactor. This is the formula. This is it. This is my metric. But the longer-term one is interesting to look at as well. All right, so let's see what we have here. Let me make that bold so you guys can see that a little better. Okay, number one. We'll just start from number one on this one. Look at number one is Maxi. Wow, this is incredible. 25% yield. They only have the NAV returns for the quarter. They only have 8% NAV return for the quarter with the 25% yield. You can see why they didn't make the other MaxFactor, the short-term list. In the short term, they haven't done as well as some of those other ones in there. But if you factor in last year also, they had 100% total return in the past year. That's really, really good. Then we have YBTC at number two, 39% yield. Not doing that great this quarter as far as NAV return goes. I mean, 4% is good, but I'm saying not as good as the ones we just looked at. But man, for a year, they are really killing it. All right, so here's going to be our first comparison for the high yield MaxFactor. Let's compare YBTC, or for the long-term MaxFactor, my apologies. Let's compare YBTC to YETH. YETH was on the short-term list, but I wanted to compare these two. One is it sells Bitcoin volatility. One sells Ether volatility, Ethereum volatility. So let's just run this for a quarter and see. Now, I would expect YETH to win because it was ahead on the short-term list. YBTC didn't even make the short-term list, but let's just check it out anyway. Let's see how close it is. Yeah, YETH is winning. We would expect that. All right. Well, I mean, they're both doing well, but Now let's go back. Let's go since inception and see how we're doing on these two. Since inception, YBTC is the boss. YETH has been doing better lately, though, for sure. All right, let's get back here and see what else we have on the long-term list. Now, KQQQ made both lists, and it's the first one to make both lists. So I guess if you had to say an overall champion, I hadn't even thought about doing this yet. The one that's the highest or that's on both lists. And Goop was on both lists too. So anyway, these are both really good. KQQQ, drawback to KQQQ is a low yield. But what does a low yield mean? That's right. It means there's less, it causes less problems with the NAV. And like I say, a high yield is a tax on future NAV upside. So let's compare KQQQ and Goop. These are both from the other list. Goop is from Curve, of course. This is since inception. And boy, KQQQ is just doing a great job, isn't it? Or I don't know, since inception may be the wrong word. It's a year. Let's go back since inception. Let's look at them, both of them since inception. I guess that was since inception. Okay. KQQQ's doing a good job. Goop's been pouring it on lately. All right. Also on the long-term list, we have AMZP. That's a good Amazon-based fund from Curve. MSFY, of course, that was on. Was MSFY on the other list? I already forgot. Yeah, it was, wasn't it? Yeah, of course. It was 10th on the other list. YMAG. Now, YMAG didn't make the short-term list. And why is that? Well, because it's unbalanced. It paid a lot of yield, but it did not have a great time with NAV. It was flat on NAV for the quarter, in a quarter when the market's face ripping. So, I mean, it comparatively speaking, YMAX had kind of a little bit of a rough time here. Speaking of a rough time, look at QQI. This is a fund everyone loves, but it's had, it hasn't had the best time on NAV. 7% is decent, but I mean, it only paid a 13% yield. So this one, is also not having its best quarter or its best year. Now let's look at GDXY. I was going to say, speaking of NAV problems, look at GDXY. GDXY is actually down on NAV for the quarter. However, you look back for the past year, they're made 31%. QQI total return for the past year, 29%. Just having a little bit of a rough time this quarter. So that's why it didn't make the other list. Let's go back. The other list, the Q-based funds that did make the other list were QQY, QDTE, QDTY, and KQQQ, and FEPI is basically similar. So we have a lot of competition in that element of the market right there. They're all good. A lot of people swear by QQI and SPY. So IDEVO is a good one. Yield a little bit low, 5.43%. You could see why it's not on the short-term MaxFactor, because it has low yield and single-digit NAV return. So there's better choices over the short-term horizon, but over the past year, I mean, hard to argue with the 26% total return. QDTE is a good one. I mean, QDTE is from Round Hill. A lot of people like that one. 35% yield, 5% quarterly NAV return, but a 24% total return for the past year. MSFO, FEPI made both lists. SPY is the stablemate of QQI. They both do a good job. QQI pays a little bit higher yield, and that's because NASDAQ stocks are more volatile. So I would expect maybe SPY to have better NAV return, but it doesn't. QQI has it on both categories right there, and that's why it's ranked ahead, and that's fine. Somebody has to win. There has to be a winner somewhere, right? All right, then what else do we have? Devo. Devo has kind of a low yield. I want 6% to be in the Maxfactor. I'm not sure if I should delist this. I mean, I'm not going to. People still think of this as a high yield. We'll keep it in there. We're going to make an exception. Maybe I'll make the rule it has to pay more than bonds, and bonds pay like 4.25. The 10 years paying 4.25 or something. So it's at least higher than that, I guess. Anyway, and then we have GUI. Now GUI pays a nice yield at 32%. FTHI, that one's been around forever. That does a good job. CEFS, are you kidding me? I've never seen this one in here before. So this is a closed-end fund, and we do evaluate some closed-end funds. And I have 3 or 4 of them in there. The other one I'm thinking of is CLM from Cornerstone. Let's just run CEFS against CLM and see what we got. Going back 3 years, boy, CEFS is really putting it on CLM. A lot of people love CLM. I didn't realize how well CEFS has been doing. That's pretty good. Let's compare CEFS to maybe like SPY. I'm just trying to give it better competition than CLM. CLM over the past 3 years, you could see. Boy, look at this. CEFS is beating SPY, and people love SPY. Let's see if CEFS can beat triple QI. My next question is, how did CEFS not make it in the short-term list? But I think I know the answer, but we'll go back and look. Wow, look at this. CEFS even beat triple QI. Wow, CEFS is our newcomer of the week. But let's look at CEFS. Yeah. So the reason it didn't make the short-term list is it had a sub 5% NAV return for the quarter. And, it only had single digit. There was better choices in the short term. There was all of the ones on the short-term list had double-digit yield and double-digit NAV return, basically. I mean, that pretty much. I mean, we had one that had single-digit yield, and we had like 4 that had single-digit NAV return. But pretty much to be on the shorter-term list, at least this week, you need double-digit yield and double-digit NAV return, and we have a lot of those that had it. All right, so let's go back here. CEFS is definitely the newcomer of the week. We're going to keep an eye on that one. We have all QILD from Global X. That one has been around forever also. Let's just do something fun. Let's compare the ones that have been around forever. We have QILD and FTHI. Where's FTHI? I thought FTHI was on this one. Maybe FTHI made the short-term list. Wow, I forgot about that. Where did I see FTA? Did I not see First Trust? I said it had been around forever. Am I imagining stuff? Oh, no, it isn't. I'm sorry. I'm just missing. It's down here at 17. Okay. QILD against FTHI. The battle of the old man. I could be in this battle. I'm an old man. So QYLD. Now, there's not really a fair comparison. QYLD is based on the NASDAQ. FTHI is based on the S&P 500. But let's just run it anyway. We'll run it over the past, what is that? The past 3 years or 3.2 years. Yeah, FTHI is just doing a better job over that time frame for sure. And that's despite the fact that it's based on the S&P. All right, let's get back over here. And then rounding out the list, we have Snowy. So look at Snowy. Now, Snowy's just had a problem this quarter. I mean, down 12% on NAV return this quarter, but my Lord, 48% total return in the past year. That's incredible. Not to mention it's paying a 70% yield. Lots of good choices out there. There's really no right or wrong choice, in my opinion. There may be a right or wrong choice for you, but these could all, maybe not all, but most of these you could make a case for having them, for filling a certain role in your portfolio. But to be fair, though, other people, there's probably some people, a lot of people probably that shouldn't touch these. So anyway, but for people that are into these high yield funds, I could make an argument for Maxi, but I could also make an argument for SPY. And they're kind of at different ends of the spectrum. Let's compare them. Let's just compare them. And we'd expect Maxi to be ahead, but not all the time. It depends on the variance, like I was talking about, and about all kinds of stuff. But yeah, Maxi's doing well. But so let's talk about, why is Maxi doing so much better than SPY? Does SPY suck? No. These things can only get the upside that the parent will allow them to get. People say that covered call funds don't catch upside and they're capped. Well, yeah, but they do catch upside, because they sell out of the money options, and they also roll. They do something called rolling, what option traders do, and it simulates catching upside. They move with the market, and so they can catch some upside. Now, generally not as much as the parent asset, but in any event, these are just like these are tools, but you have to have a hot underline. Well, Maxi's underline is Bitcoin, and Bitcoin has done a lot better than SPY. Well, let's just try to prove that. Let's look at, do we have BTC now? Let's just compare IBIT, which is Bitcoin, to SPY. Okay, so there we have it. IBIT just, there's been more upside to capture in Bitcoin than in SPY. These things can only do what they can do. I sometimes compare these to like putting a solar panel on your roof. If you put a solar panel on your roof, but you live in Maine, or you live in England, let's say, and it rains 300 days out of the year and you never get any sunshine, is it the solar panel's fault that you don't generate electricity? No, it's not. It's the sun's fault, right? All right, guys. Well, I appreciate y'all for being here. I hope you have what's left of your day. Please tune in for my interview with Mike Coe on Thursday at 1:00. And it's going to be a live interview. You guys can put questions in the comments form. All right, guys. Thank you very much. I hope you enjoyed the Max Factor, and you have a great day.